Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 2nd, 2025, and we are diving deep into the USDCHF currency pair, which has seen some very interesting action lately. First, we'll cover the crucial news and fundamental drivers impacting both the US dollar and the Swiss franc. Then, we'll get into the charts to identify key levels, trends, and potential trade setups. Let's start with the big picture news. The primary story this week has been the U.S. government shutdown and its subsequent resolution. Initially, the shutdown caused a sell-off in the greenback due to the uncertainty it created. However, as the dust has settled, we're seeing the U.S. dollar pair some of those losses. This has directly contributed to the bounce we've seen in USDCHF from its recent lows. Adding to the dollar's woes is a cooling labor market. The recent ADP employment report came in much weaker than expected, showing a loss of 32,000 private sector jobs in September. This, combined with other soft labor data, is fueling speculation that the Federal Reserve might consider cutting rates later this month. The government shutdown has also threatened to delay the key non-farm payrolls report, leaving traders in a bit of a data blackout. On the other side of the pair, we have the Swiss franc. The Swiss National Bank, or SNB, has a completely different monetary policy stance compared to the Fed. While the Fed has been hawkish for a long time, the SNB has been actively cutting rates, bringing them all the way down to 0% to combat deflationary pressures and a rapidly appreciating franc. SNB President Martin Schlegel recently indicated they intend to keep rates on hold for the foreseeable future, which provides some underlying support for the franc. This massive divergence in monetary policy, a hawkish Fed versus an accommodative SNB, is the primary long-term bullish driver for USDCHF. Now, let's turn to the charts to see how this fundamental backdrop is reflected in the price action. Looking at the daily chart, we can see the broader story of this pair over the last year and a half. After peaking above 0.91 in May of 2024, USDCHF entered a prolonged and severe downtrend. This downtrend accelerated dramatically in April 2025, with a massive drop from around 0.855 to below 0.82 in a single day. The selling pressure continued through the summer, with the pair eventually carving out a significant bottom just 2 weeks ago, around mid-September. That key low was established right around the 0.7850 level, which now serves as our most critical long-term support. Since that low, the price has reversed sharply, initiating a new short-term uptrend. This recent rally broke above the psychologically important 0.8000 level last week, though it has since pulled back slightly. We can see a clear pattern of higher highs and higher lows since that September bottom, which is a classic sign of a trend reversal. The price is currently consolidating after a strong push higher, which is healthy market behavior. The key resistance level to watch immediately is the recent high from late September, just above 0.8000. If we can clear that, the next major resistance zones are found near 0.8100 and then the much heavier 0.8200 area, which was a support zone back in June and July. Now let's zoom in on this recent reversal. We're filtering the daily chart to show the action from September 1st onwards. Here you can clearly see the bottoming process around 0.7850 in mid-September. Notice the strong bullish candles that followed, indicating a decisive shift in market sentiment. The rally was strong enough to push the pair up nearly 200 pips in just over a week. The last few daily candles show a pullback and then a bounce. Specifically, the candle for October 1st shows price dipping to a low of 0.7925 before rallying to close near 0.7970. This price action correlates perfectly with the news we discussed earlier, the dollar weakening on shutdown fears and then bouncing back as those fears subsided. Switching over to the 1-hour chart, we can analyze the recent bounce in greater detail. Here we can see the price action over the last few trading days. The dip to the 0.7930 area is very clear on this time frame, forming a short-term support level. From that low, the market has established a clear upward channel. The bounce has been methodical, with price creating a series of higher lows and higher highs. This confirms the short-term bullish momentum is currently in control. Immediate intraday support can be seen around the 0.7950 mark. The primary short-term resistance is the recent swing high near 0.7990, just below that big 0.8000 figure. For our day traders, let's drill down to the 15-minute chart for the last 24 hours. You can see the price was consolidating in a tight range before the European session yesterday. Then, we saw a sharp dip, followed by an aggressive breakout to the upside. This is the bounce from the 0.7930s playing out in real time. For those looking for bullish entries, a potential strategy would be to wait for a pullback to a support level, like 0.7950 or 0.7960. A stop loss could be placed below the significant recent low of 0.7925. The initial target for such a trade would be a retest of the recent highs and the psychological 0.8000 level. On the flip side, a bearish scenario would gain traction if we see a decisive break below that 0.7925 support. Such a move would invalidate the current bullish structure and could signal a deeper correction. So, to recap everything, let's go back to our daily chart. The long-term trend has been bearish, but we have a confirmed short-term bullish reversal in play. Your key price levels to watch are as follows. Critical long-term support is at 0.7850. Immediate support, and the line in the sand for the current rally, is at 0.7925. The main hurdle and psychological resistance is at 0.8000. A break above that level opens the door to further upside, with targets at 0.8100 and 0.8200. Now for our unbiased predictions. The bullish case seems more probable in the short to medium term. I'd give it about a 65% chance. This is supported by the chart's reversal pattern, the easing of immediate U.S. political fears, and the powerful underlying theme of Fed/SNB policy divergence. A sustained close above 0.8000 would strongly reinforce this outlook. The bearish case, with a 35% probability, would require a new negative catalyst for the U.S. dollar. This could come from a disastrously weak non-farm payrolls report or renewed political turmoil. A break below 0.7925 would be the first major warning sign for bulls and could trigger a slide back towards the 0.7850 lows. Keep a close eye on upcoming U.S. labor data and any statements from central bank officials. That's our analysis for today. Remember, this is not financial advice and is for educational purposes only. Always conduct your own research and analysis before making any investment decisions. If you found this video helpful, please hit the like button, subscribe to Explain the Charts, and let us know your thoughts on USDCHF in the comments below. Thanks for watching and happy trading!